If you want to lower your lifetime tax bill, you're in the right place. Welcome to Rooney & Associates T&T Tax Strategies, where we believe in paying Uncle Sam what you owe, but never leaving a tip. Today we're discussing stealth taxes and how to avoid them. Sometimes these taxes are called shadow taxes or hidden taxes. These are taxes you pay that are not immediately obvious in the tax code and are triggered indirectly, often by inflation or reaching specific income thresholds. The most common examples of stealth taxes are the taxation of Social Security, Medicare premium surcharges, and the 3.8% net investment income tax. Let's begin with the taxation of Social Security benefits. A portion of Social Security benefits can become taxable once a recipient's income reaches certain thresholds. Since these thresholds are generally not adjusted for inflation or are adjusted very slowly, more retirees are pulled into paying tax on their benefits over time. The amount of Social Security benefits subject to tax is tied to your provisional income, which is your adjusted gross income plus tax-exempt interest plus half of your Social Security benefits. 50% of your benefits are taxable if provisional income is between $25,000 and $34,000 for single filers, or between $32,000 and $44,000 for those married filing jointly. 85% of benefits are taxable if provisional income exceeds $34,000 for single filers or $44,000 for those married filing jointly. Next are Medicare premium surcharges, or IRMA, which is short for Income-Related Monthly Adjustment Amount. This is an extra charge added to Medicare Part B and Part D premiums for individuals whose modified adjusted gross income exceeds certain annual thresholds, as seen in the chart provided. An increase in taxable income, such as withdrawing money from an IRA or selling investments, can push you over an IRMA threshold, resulting in significantly higher Medicare premiums for the following year. Finally, on our list of usual suspects for stealth taxes is the 3.8% net investment income tax. This 3.8% tax applies to the lesser of your net investment income, for example, capital gains, dividends, and interest, or the amount by which your modified adjusted gross income exceeds certain thresholds, $200,000 for single filers and $250,000 for those married filing jointly. Since the thresholds are high and often not indexed for inflation, more taxpayers, especially high income earners, become subject to this tax over time. So how do you avoid these stealth taxes? The most effective strategies generally involve controlling your adjusted gross income and your modified adjusted gross income, particularly in retirement. We discussed many of the following strategies in more detail in our other videos, so I will just briefly describe them here. Specifically, to mitigate the taxation of Social Security and to avoid the IRMA surcharges, you can employ systematic partial Roth conversions, as tax-free Roth withdrawals do not count toward provisional income or IRMA thresholds. You can also focus on tax-efficient proportional withdrawals from different buckets of money to keep your taxable income low. Qualified charitable distributions are another strategy. If you're age 70 and a half or older, you can donate directly from your IRA to charity. This amount counts towards your required minimum distribution, but is excluded from adjusted gross income, which can help keep your provisional income lower. With regards to the 3.8% net investment income tax, you can use a strategy called asset location, where you hold investments that produce higher ordinary income in tax-deferred accounts, such as your IRA, and then you place investments that generate capital gains in taxable brokerage accounts or Roth accounts. Municipal bonds may also work because interest from municipal bonds is generally exempt from federal income tax and is often excluded from net investment income and your modified adjusted gross income. Finally, in terms of general tax management, you can use techniques such as tax loss harvesting, where you sell investments that have lost value to offset capital gains and ordinary income, reducing overall taxable income. If you're near the standard deduction limit, you can bunch itemized deductions or charitable donations through a donor-advised fund into a single year to exceed the standard deduction, and then take the standard deduction in subsequent years. If you want more tips on lowering your lifetime tax bill, be sure to check out our website at raawealth.com. I'm a chartered financial analyst and financial planning professional. My name is Jamie Rooney.